Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the low volatility anomaly.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss low volatility anomaly. There are a lot of trading strategies and anomalies that are based on past volatility or predicted future volatility, etc. etc. We have over 70 or 80 of them in our database. The volatility is a very common measure of the risk. These kind of the strategies that are quite popular. Today we will discuss the low volatility anomaly, the basics of all of those systems. So what is the low volatility anomaly? The CAPM, capital asset pricing model, is a quite old model. When it was firstly introduced in 1972 or late 1960s, it predicted that the expected returns should be positive and should be a linear function of the beta or a function of the risk. So it means the higher risk you have for an investment or the more risky the stock is, the higher return it should have. But we have more data at the moment, and right now it's 2023. So we can take a look on the data and we can assess what is the risk-return relationship in reality, and we see that it's not at all a linear function. But in reality, high volatility stocks, high volatility portfolios usually have a lower return than low volatility stocks. So this is how does it look like when we sort portfolios based on the volatility, and that's the basis of low volatility anomaly and low volatility strategies. The low volatility factor effect in stocks is a strategy that's freely available in Quantpedia. You can read about that in our screener. We have a lot of research papers that are related to the strategy or anomaly, so you can learn more about that. As mentioned in a Wikipedia article, the most important thing is when we sort the stocks into deciles based on the past historical volatility, we see that the decile number 1, so the decile with the lowest volatility, has the highest return, and of course also the highest Sharpe ratio. On the other hand, the decile with the highest volatility stocks has the lowest return and lowest Sharpe ratio. So when we long short the universe, so we go long the low volatility stocks and we short the high volatility stocks, we have a market neutral portfolio that has a nice return and also nice negative correlation to the overall market. So that's the low volatility anomaly, that's the low volatility strategy. It can be employed even long only or long short, it's up to you. But there is another article that I would like to mention. It was just published on our blog. It's called Dissecting the Performance of Volatility Investing. It's based on the paper written by 3 researchers from Invesco investment company. What this is talking about is that on the one hand, the low volatility strategies can reduce total risk and can enhance the portfolio risk adjusted returns, but it doesn't mean that you will be able to beat the benchmark with these portfolios. So because as we can see here in a Wikipedia article, low volatility portfolio has the highest Sharpe ratio because it has nice performance and the lowest risk, but there are other portfolios with a higher performance. And of course, the highest volatility portfolio has the lowest return and the worst Sharpe ratio. But it doesn't mean that the low volatility portfolio will beat the benchmark on absolute basis. It will beat it probably on a risk-adjusted basis, so with the best Sharpe ratio. But what if you want to beat that portfolio on a total return basis? So what the authors of the paper did, so they were able to decompose the active return of the low volatility portfolio into the low volatility effect or anomaly and an allocation effect. What is an allocation effect? Allocation effect means how much market beta you have in your portfolio, and low volatility anomaly is how much low volatility anomaly you have in a long only portfolio. So when you decompose long only low volatility portfolio into these 2 parts, when you plot them and when you check them how the parts perform based on a market portfolio performance, you would see that during the times when the market return is a negative, those are the times when the low volatility active return, so the low volatility portfolio, performs the best. But on the other hand, when there is high performance of the market return, so the market is performing very well, low volatility portfolio in a long short fashion is not performing so well. So what does it mean is when you have a long only low volatility strategy, the drag in a performance or the reason why your portfolio may underperform against the market on an absolute basis, so not on risk adjusted. On risk adjusted it will outperform, but on an absolute basis is because it doesn't have high enough beta to capture the upside of the equity market. So the very easy way how to capture the upside beta and still have a nice performance is to leverage low volatility portfolio to get the approximately the same risk. So what does it mean is you will take the low volatility portfolio and you will, through the futures or through some leverage obtained from your brokerage, you will leverage this portfolio a little. So you will increase your volatility, you will increase a little of your risk, but the compounded return will be even the better. So at the end, you will have the portfolio that will be able to outperform market or average of the market, not just on risk-adjusted returns, but also on absolute basis. So that's their proposed solution. Otherwise, I recommend you to check the paper. It's full of other interesting ideas, and you will get a better understanding of low volatility anomaly, not just in long only fashion, but also in long short fashion. So thank you very much. I hope that you liked today's video about low volatility effect. Once again, if you are interested, feel free to visit Quantpedia, check what we have written about low volatility or about the other anomalies. Please subscribe to our YouTube channel, so it will help us a lot. Give us the like, and I hope that you will join me in the next video. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.